Hey, good afternoon, everybody. Going to go over our Forex trades for today, Wednesday, January 20th. We did have two trades in Aussie dollar and Aussie yen. Pulled out 6.7 pips on a size adjusted basis, 16.9 on a non-size adjusted basis. So we'll go over them in a minute. First, just want to talk about economic news. We got, hold on a second here. This morning we had CPI, Consumer Price Inflation Index, came in at a negative 0.1%. The core, that missed estimates, was worse than expected. Core CPI came in at 0.1%, which also missed estimates. And then we had housing starts. Again, we've been so bearish on housing. Housing starts fell 2.5% in December versus an estimate of a gain of 2.3%. And building permits fell almost 4% for the month. So again, not good. The new law that the government put out last week that they instituted of not allowing any more anonymous cash buying of houses is only going to hurt the real estate market even more. And we've been saying it and saying it and saying it, and it's happening right in front of our eyes. It's going to get worse now that the government created this new law. It's actually mind-blowing. They should, if they wanted to do it, why weren't they doing it when things were rosy before the financial crisis, or even a year and a half ago when housing was relatively stable compared to now? Another blow to the Fed came out. Earnings growth slowest to the weakest since 2014. This a month after they raised rates. Goldman Sachs cut fourth quarter GDP down to 1%. That's no big deal there. I'm trying just really looking at U.S. news. Canada came out with their interest rate decision. They left it unchanged. No big deal, but they did lower their GDP forecasts. Ray Dalio, which is a huge hedge fund manager, manages, I don't know, $20 billion or something. He says there's more risk to the downside than there is to the upside, and that's pretty much a given. He says the Fed should remain flexible, and he also expects the Fed to institute QE4. Something again that we've been saying we wouldn't be surprised to see if it happens. And here's one of the biggest guys out there saying that he expects them to do it, not that they may do it. So I found that pretty shocking this morning. Let's see, just kind of scanning through. Someone came out from the ECB this morning and said that Italy must start reducing their debt to GDP. It's like finally someone has recognized that debt is not all it's cracked up to be. We have this Keynesian theory, and then that guy Krugman from, I think he's a Nobel Prize winner for economics. They think debt is good. Well, it's not. It's not all cracked up to what it can be. It could be good if it's used in a smart manner or a mature manage it properly. Don't let it get out of control. Well, Italy's it's out of control. We know Greece is out of control. They're done. And many other countries in the United States, we're not that far behind. We're at 106%. Our debt to GDP is 106%. That is not good at all. I got news for you. You might see some headlines tonight, tomorrow, over the weekend, or in the next few weeks that oil is now cheaper than milk and water on a per gallon basis. There are some gas stations selling gasoline under $1. You buy a gallon of water, usually somewhere around $1. And by going to by buying milk, you buy a gallon of milk, $3.50, $4 for a gallon of milk, and here you are at the gas station paying somewhere around $1 for regular, even super. I paid I think I paid $2.09 for super the other day. That's still cheaper than a gallon of milk. So you're going to see it, and they're going to say, well, because there's so much supply, or you might hear there's no demand because this, that, and the other thing, because the economy is so weak. We're not saying the economy is not weak, but it's simply not a case of supply and demand. Oil prices is a case of supply and demand, but oil prices go to an extreme. They probably shouldn't have went as high, $120, $130, $140 a barrel a couple of years ago, whatever it was, a year and a half, 2 years ago. And they shouldn't be $30, $28 a barrel that they are now. Why do they go? Because you have traders that trade just like we trade. They look at a chart of oil, it's going to look just like this, okay? I mean, it's going to shape differently, but it's going to be a chart. And they're going to say, oh, well, you know, if it breaks this level, I'm going to go short. And you have a massive amount of money in the business of trading oil and not using it as a hedge for their business, as an airline company does, or a massive trucking company might, or a rail company may. They're going to buy oil futures to hedge their expenses going out. Well, that's fine and dandy, but you have billions, if hundreds of billions, if not trillions of dollars that actually trade oil for one purpose only, to try to make a profit. And when you get the crowd going in one direction, either down or up, you're going to influence the price of oil in a big, big way. So should it have been, like I said, should it have been $120, $130, $140 a barrel? Probably not. Should it be 28? What are we at? $28, $29, $30 a barrel now? Probably not. Matter of fact, when it was $130, a big firm, I might have been JP Morgan, they came out and said, if you were to remove the speculation, not, you know, just like I said, traders speculating for one thing only, to make a profit. If you were to remove speculators, it would reduce the price of oil by as high as 2/3. So think about that, right? So a half would have, at 130, a half would have bring it down to 65. So JP Morgan, I think it was, I'm not 100% sure JP Morgan, but it may have been. So if that analyst is correct, it could have brought it down. He's saying fair market value for oil, if it was left up to only companies using it as a hedge, should be somewhere, you know, 45, 50, maybe 55, 60. You know, maybe his analysis isn't quite accurate. Maybe it's, if you removed all the speculators, it would be 50%, right? So it should, the way I look at oil, it should be anywhere between 45 and about 65, maybe $70 a barrel. So right now we've gone to the extreme. And again, you're going to hear that it's all supply and demand, and it's not all supply and demand. Believe me when I tell you. And as you know, we've been saying all along that the Fed, even though they're telling us they ended QE, that they haven't really ended QE, because there's no mandate for the Fed to give the money back. There's no mandate for the Fed to, when bonds pay interest and or the bonds mature, there's no mandate for them to give the money back. So what we've been arguing, what the Fed is doing, is continuing a QE by reinvesting those interest payments and reinvesting those bonds when they mature. Guess what? Last night, JP Morgan releases a story on Bloomberg, and Bloomberg covered it. Exactly that. That QE, even though the Fed tells us they're really not, it's really not ended, that they're reinvesting interest payments, they're reinvesting the bonds and treasuries when they mature. And matter of fact, and they went so far in depth in it, they said in this year alone, the Fed will be buying half of the treasuries that are issued. Half of the treasuries being issued this year are going to be bought by the Fed. That is absolutely staggering. So there is no way, when people tell you QE has ended, there's no way. The other clue that QE hasn't ended, the Fed raises rates last month. Here we got the Fed fund futures trading below the level the Fed just raised the rates to. We also have the 10-year Treasury today trading under 2%, the lowest in about 4 months, when the Fed just raised rates a month ago. So the street is telling the Fed they made a mistake. The street is realizing the Fed has not ended QE, even though they claim they have. And I believe the street is more afraid of the Fed unwinding its balance sheet than doing actual raising of rates. So we've seen markets around the world react the way they've reacted since the Federal Reserve raised rates. And the first 2 weeks after they did it December 16th, right around the holidays. So the first 2 weeks, the desks were light and you didn't have a massive trading going on. So there wasn't a big reaction. And it all kicked in after the new year. And since the new year started, it's been nothing but carnage. Everyone's blaming China, of course, but you can't put all the blame on China. So the Fed, hopefully they're seeing what's going on by them just raising 1/4 point. If the Fed decided to unwind its balance sheet, no longer do any reinvesting, give the money back whenever those bonds mature, interest payments, just give it back, that would have a greater impact and a faster impact than raising rates 1/4 point, maybe another 1/4 point in a few months, 3 months, another 1/4 point 3-4 months later after that. And I think the street is realizing that, and the street may start. I don't think they have started to, but they may start to move markets in advance of the Fed unwinding balance sheet. So if the Fed ever hints that they're going to start unwinding it, look out. And I really hope Janet Yellen and the Fed are listening to the markets, reading a report like that. If they don't have their own brains themselves, I think they do. So I don't think they have any plan on unwinding it soon. Again, hey, they might have to institute QE4 if things get ugly enough, right? So we've been saying all along that they've painted themselves into a corner, and man, that corner is shrinking. The paint is coming closer and closer to their feet. Okay, running out of time here on this video, and I'm sorry I took up a lot, but 2 trades, like I said, picked up 6.7 pips. It was a correlation trade between Aussie dollar and Aussie yen. Aussie yen was the lead. This was the one that we were shorting. We shorted Aussie yen at 80.943, covered at 80.535, picking up 40.8 pips or 16.3 on a size adjusted basis. We have 40% of our normal size. And in Aussie dollar, we have 40% of our normal size as well. We were long this 0.68964, sold at 0.68725 for a loss of 23.9 pips or 9.6. So the net result is being a positive 6.7 pips on a size adjusted basis. Again, the lead was this. The algorithm was giving us an 88% chance that this move was going to come down. It was still above this trend line it was right near that trend line. So we didn't want to take it as a pure directional play, because then you're taking completely directional risk. So by adding the Aussie dollar as a synthetic hedge correlation, you're reducing your directional risk greatly. So if the algorithm was wrong and it started to bounce on us, although we would be losing, we wouldn't be losing as much, because Aussie dollar would be bouncing along with the Aussie yen. So that's it. We're going to wrap it up. If any signals come out, they'll be coming your way. We'll be back tomorrow, assuming we get some action tonight or tomorrow morning. Have a great rest of your day.